think firstly to your point about US tech, it's much harder for that kind of structure to influence some of the sustainability plays in Europe, because there simply isn't an options market over many of the names. What I'd say, the similarity for us is that you have a structural growth thematic where, if you look at the fiscal support that's coming in for sustainability, all of the programs, the way in which the kind of fiscal package has been orientated to make sure it helps provide green stimulus. And indeed, the US election, this is another possible catalyst that people have been looking at for sustainability momentum in Europe, which is that one of the candidates is proposing, I think it's a $2 trillion Build Back Better program. For us, that's the kind of long-term structural growth story in Europe, where again, you have a lot of these kind of positive actual catalysts: fiscal stimulus, low rates, investor interest, and of course, then on top of that, you have this concept that increasingly funds are trying to recalibrate to have more, higher sustainability characteristics in their portfolios.
Jimmy, just walk us through some of the areas. You've mentioned renewable, electrification, hydrogen, just some areas that investors should be taking a look at here in Europe.
Yeah, I mean, they are quite catalyst driven. If you look at, the way in which some of the stocks reacted to some of the, the EU hydrogen proposals back in July, you can see that, for me, I think it's a sign that the market isn't perhaps as across some of these issues as it should be. And indeed, we as, strategists, we've spent the bulk of our year focusing on COVID and monetary policy response. I think that the next catalyst that's coming up is the subject of renovation. Obviously, one of the big things in terms of sustainability is not just using more green energy, but bringing down the overall level of energy that people use. And one of the sort of big energy leakages is the fact that buildings are not necessarily as energy efficient as they should be. Now, if Europe engaged on a huge process of renovation to make buildings more efficient, and you think about the amount of capital that requires, you don't actually have that many companies that are in the space and able to do that. So the valuations on those companies can become very, very stretched. And indeed, you would expect a lot of compounding of earnings on a sort of 2 to 5 year view. So renovation is the next topic. Sustainability, obviously, renewables, etc. I think it's all part of this idea that in order, and I think you had commentary this morning about Gentiloni talking about, in order to provide, to not mortgage the next generation's future, but to provide for them, all of the borrowing, all of the stimulus, all of the expansion has to be very, very green focused going forward.
Jimmy, it's fair to say that you and your team have been pretty sceptical on the chances of a decent sized recovery on the market. A couple of months ago, you thought the market was worth 2,700. I'm using the S&P as a metaphor here for broader markets as well. Then you've gone up to 3,300. Has your scepticism abated aggressively over the last couple of months, or have you just had to go with the flow?
So I think, if you're talking about the kind of research strategy targets, and there's been this kind of ongoing debate between this massive bifurcation of earnings expectations versus just what happens when you have $20 trillion trying to find a home. The turning point for us as a sort of more tactical desk, I think, was when the Fed turned around and said, look, we're going to be looking at buying high yield bonds. Which meant that they were just not going to allow risk assets to become any part of this problem. From here, I think that it's becoming more problematic to extract more upside, if you like, from the structural growth story, and a lot is just going to be about whether or not we do see this marrying of fiscal and monetary policy to create inflation expectations. The most recent interesting call that our quant group made was that they want to now be long value. That's the first time they've been looking at that in 18 months, but they want to do it in a very kind of inflation expectation linked way. They don't want to be looking at financials because there isn't a lot of belief out there that the nominal curve is going to rise. My view is that risk assets now continue to seem to be very highly correlated with balance sheets. If you think that the balance sheet expansion is going to slowly taper into the end of the year, that suggests that there's not a huge amount of upside. And obviously we have these kind of impending overhangs, not least the US election and now Brexit, which seems to be more of an October phenomenon now than a December one.